Hello, Jonathan. I just promoted you to a panelist. So you are muted, Jonathan.
Not letting me start video for some reason. So it's saying that you've disabled screen sharing. Brendan, it's not allowing me to provide a video.
All right, I should hear you now.
Can you hear me, Brendan?
All right, Jonathan, can you do a quick sound check?
Can you hear me? Brendan, I'm not on mute.
Test. And you should hear you now, Jonathan.
Brendan, can you hear me?
Yeah, we're good now. Apologies for that. Just the Zoom error here.
No worries. It's not allowing me to start the video recording either, or just to start the video.
We're already recording, so we'll get that edited up. And everyone gathering in, we'll get started in a few minutes here, just as we have people hop in. And do you have your screen enabled, Jonathan? Or I can.
I do. It's like I said, it's not allowing me to start video. It says you can't start your video because the host has stopped it.
Okay. Yeah, there's always fun Zoom settings here.
I can now see you, which I wasn't able to do.
Yeah. So I'm going to make you the host, Jonathan. That should let you turn on your video now. There we go.
Nice.
All right, great to see you. All right, so we're just going to let a few minute more or two here for people to gather, and then we'll get kicked off and get started.
How's everything in Austin today?
It's beautiful again. We had people think we're not tough here with the cold. After 2 years here, I'm certainly not tough anymore. It snowed a night or two ago. We've had early voting going on, so people have been all rushing in to get that last. I got mine done a while ago. But if we had a few people in the chat, we can have people sound off where they're at, see where they're at in the United States, and we'll get started talking on some commercial real estate here.
Texas has really looked aggressive out of the gates in terms of the early voting. It's impressive.
Yeah, it's a lot more turnout, and a lot of people moved here, and just a lot, it's such a state that had always thought people were decided like, hey, it's Republican, so I don't really need to vote. Both Republicans and Democrats did not vote that much because they felt everything was predetermined. So the enthusiasm has been very high.
Yeah, I don't have a fight in that horse, but I think this is something that we're going to touch on in this conversation. But if you're focused on demographic trends like I am and we are at my firm, there's a lot of indications that that Texas is going to be blue within the next 5-10 years.
Yeah, and I think I'll just start talking about some Texas real estate, and then Jonathan, I'll let you. We'll start hopping into it. So we have obviously Dallas, Houston, Austin. Anything between Austin and San Antonio is now developing all these little towns and in between, and are seen as these major hot real estate markets. So where are you seeing some of the biggest development, not only in Texas, but across the United States?
Yeah, I think that narrative that gets a lot of play right now is the suburban push. The fact that so many people there's a mass exodus. So many people are migrating out of the traditional kind of coastal gateway MSAs for secondary and suburban growth markets. So when I say traditional MSAs, I'm thinking high tax, high rent, high cost of living places, New York, Chicago, Los Angeles, San Francisco. And where they're landing left and right, Austin will be the first to attest, and I'm right behind them, is Austin and Nashville. I feel like there's almost some sort of kind of friendly rivalry that's developing between Austin and Nashville. A lot of kind of parallels in terms of, the new residents we're picking up. They're coming from thoughtful places. They're treating both Austin and Nashville as a destination. I think that creates a certain type of energy in the respective cities that is at least attractive to me. And, I think there's burgeoning tech communities that are really kind of gonna continue to grow in both cities because of that. That said, what we say about Nashville here, it's a great place to live. It's a tough place to buy. Quite frankly, we're priced out, and we have found that most of our portfolio is better situated across the Midwest and Southeast in secondary markets that we really believe have a high quality of life attached to them, as well as affordable single family housing and access to really solid quality public schools. Those have really been the driving forces behind at least the millennial migratory patterns, and I'm happy to dive into that at a deeper level.
Yeah, and Jonathan, let's just we're letting people gather here. Let's talk about who Excelsior Capital, a little bit about yourself. Just for the people at Rocket Dollar here, why do we have these conversations? Rocket Dollar doesn't provide investments. We obviously have plenty of people investing in real estate, but not everyone at Rocket Dollar is a real estate expert. We lean on our partners to be both real estate experts and also educators on the space. Educate, provide investments, provide access to investments, and just like a bit of market commentary right here. So I really encourage people to participate. I'll turn on the chat here and people can sound off. But tell us a little about yourself, Jonathan, how you got into Excelsior Capital and what you do.
Sure. So I grew up in South Carolina. Myrtle Beach. I admit proudly, but I usually get ribbed for that. It's got an absolutely gorgeous coastline, but it's a little bit kind of cheesier and neon as you get a little further inland. That said, I went to a small liberal arts school in Pennsylvania, Franklin and Marshall, Division III school where I played soccer. It was my first kind of real exposure as a Southern guy to the Mid-Atlantic Northeast, and I found myself drawn to it. From there, I actually chased a girlfriend up to Boston, got a job with a software company right out of college doing inside sales. Honestly, I had no idea what I was doing. That company, fortunately, was acquired by Microsoft, which gave me the opportunity to pivot and try to kind of gravitate towards a career or a vocation, at least, that I was more aligned with. From there, I moved to New York City, where I lived for the next 13 to 14 years. And I worked in investment advisement for a couple bulge bracket investment banks. First started off with Citigroup, Smith Barney, and then HSBC Securities. I knew I wanted to get out of finance, and I also knew I wanted to move back down south. South Carolina felt a little bit too small. Uh, Nashville, obviously, everything I'd read, everything I'd seen, and even though I didn't really know anybody there, the couple of people, or I didn't know anybody well, the couple of people I did just really seemed to have terrific networks established and kind of helped me kind of pull the Band-Aid off. So I moved down to Nashville slightly over 2 years ago and got linked up with Excelsior Capital, which is the firm I'm with now. Excelsior is an alternative asset sponsor and syndication platform providing direct real estate to opportunities at the asset level. And that's just kind of a convoluted, fancy way of saying all we do is we syndicate capital to family offices, accredited individuals, and boutique wealth management and RIA firms, all on a deal by deal basis. To date, we have acquisitions in 12 markets, a gross portfolio valued at over $375 million, and we run over 2.5 million square feet of commercial office space spread throughout the Midwest and Southeast. We very deliberately stay away from traditional kind of high rent, high tax, high cost of living gateway MSAs, as I was kind of intimating earlier. And instead, we target secondary suburban growth markets that we've attached a high quality of life to.
Yeah.
I'm sorry?
Can I interrupt you to
Please.
what are some of those growth markets that to give people a perspective and a picture of
Yeah,
where
great question. So what a lot of the rest of the country would mistake as flyover country, we really think that there's long-term growth prospects. We find ourselves in places like Columbus, Ohio, Cincinnati, Indianapolis, Raleigh, Durham. We just closed our fourth acquisition in Kansas City, Kansas, a market that we're hugely bullish on. Our most recent offering is in Fort Worth, the Dallas-Fort Worth metro area, another market we've been desperately trying to get into, and we finally found an entry point. We do own in Nashville, but it's an older legacy asset, and the reality is that we're priced out of the town we live in. We can't afford it, quite simply. A lot of the kind of institutional private equity elite are, in New York, Chicago, LA, Seattle, are really targeting a lot of these secondary markets now. And as kind of a local sponsor, it makes it a much more competitive market. So
Yeah.
we really are comfortable looking outside. That said, we do, from a geographic kind of perspective, to date at least, we've maintained a presence in the Southeast and Midwest.
Okay. Yeah, and I just want to share a quick story. We have all these developers in the major couple cities I mentioned at the beginning, of course, Houston, Austin, and Dallas. But there's one developer just in Tyler, Texas. He's in these other small secondary, third, tertiary towns, and the amount of value that he's finding that seems like a lot of developers in Texas are ignoring or just not making it their focus. And that's a firm like yours being able to trailblaze out to other markets earlier to really find that value. So where do we want to take it first, Jonathan? We have a couple of things we want to cover here today. We've got the suburban push that we were just talking about. How about we cover that in a bit more detail than the intro? You have these secondary, third markets that you're going after, you find a lot of value. What's pushing more people to these markets, and what makes you think those markets are going to win in the next 10, 15, 20 years for investments?
Yeah, the reality of the situation is that these markets have been experiencing population and job growth over the course of the last 5 years heading into the pandemic. I mean, it's our belief that, this is COVID is. I think the object of this conversation is to talk about kind of millennial demographic shifts, patterns, and how COVID is impacting all of that. And it's a little bit cliche and kind of hackneyed, but I think it's accurate that COVID is acting as an accelerant to pre-existing trends. What we saw pre-COVID was increasingly millennials, and especially because of the financial crisis in 2008, they had delayed their typical family formation phase, roughly about 5 years it was kind of a delayed response of about 5 years. And there was this kind of narrative on Wall Street that the millennial working generation, which is, by the way, the largest cohort in America, it's around 75 million people total, was always going to kind of live in Brooklyn, wear skinny jeans, eat avocado toast, never have children, live in an apartment forever. And that's kind of the image that we were all sold. But the reality is that they've just kind of delayed the family formation process. Thousands, we were never going to live in the suburbs and drive an SUV and send our kids to the same schools that we went to. But like most generations of the past, we yearn for that same type of kind of upbringing that we had for our own children. Let me put myself on pause there, open the floor back to you, as I know that's a lot of information.
Yeah, I'm sorry, my internet connection is not the greatest here. I just lost my video, but I'll keep it off to keep my internet a bit better. So, we're just talking about that, the suburban push, that move. You typically target, you have a lot of office space in your portfolio, and you have some other types of assets you want to comment on that may or may not be recession resistant. How do you feel, in the next year here and with these next market forces, is your office space position, and also some of the other assets that your team is investing in?
Yeah, I mean, office it's a tough conversation to have right now, no doubt. I mean, and I think that's kind of the question that we're coming up against every day. The big question in office is, and the question that investors are really trying to quantify in terms of the long-term prospects for the space, or how viable is this work from home experience? And I think early on, the kind of very initial phase of the shutdown, it seemed like all of the productivity reports were coming back just through the roof. Everybody was putting it in, getting it done. And all of a sudden, it seemed like this new normal could really exist, where the majority of us were just working remote. This is a concept that I think was unheard of several years ago outside of just kind of HR personnel. And now all of a sudden, C-suite executives are starting to internally debate it. But I think what a lot of that was that, people were motivated by fear. People were scared about losing their jobs. People were scared about an uncertain future. And everybody was actually putting in overtime and working really hard, getting it done, but they weren't consistent with it. I think if you're looking at any of the new reporting or studies that are coming out now, productivity has significantly dropped from that early, just kind of first month. And a lot of the companies, or industries rather, that you're hearing that have them are most adept or most likely to adopt a full-time kind of work from home strategy. And when I say industry, I'm primarily referring to the tech companies. They're on the sly, the ones that are buying up the most commercial office right now in record numbers. I mean, Google and Facebook in particular have dramatically increased their office footprint this year alone. Huge buildings in Seattle suburbs, huge buildings in New York City, they're not really doing, I mean, the work from home thing, I think, is going to make sense at some level. I don't know how it shakes out. Maybe it's a couple days a week you're home. Maybe it's just individual, jobs and mandates can be done individually at home. But there's always going to be that need for collaboration, and just kind of completely decentralizing your workforce. I don't think is a long-term solution. So no
Yeah.
doubt. I'm sorry.
Yeah, and thank you, Jonathan. I think in something we mentioned at the first time, we might even, there's this uncertainty that we might see the next few years, but just in the people that are going back to the office in Chicago, back in my hometown, they're more spaced out. They're cycling employees. Will we see even some more need for some companies that feel they can spend that money to spread out and use some larger office space? And then we have a few questions here popping in the chat. They're asking, do you have your own property management arm that's handling these office spaces?
We actually third party out all of our property management. We primarily do that based on the relationships that we have in that particular market. But the big names, CBRE does a lot of our property management, JLL, Cushman and Wakefield. The big names in the space are the ones that we lean on for all of our property management, and that is third partied out.
Okay. Yeah, and another question here: does the firm have an its own investment to the same fund? So is this all investor money? Is the firm putting in? How much is all investor money versus Excelsior raising themselves own family?
That's a great question. So the firm launched about 10 years ago, and we are raising money through a kind of a traditional commingled blind pool fund structure, where we would have capital calls, we'd find opportunities, and then we deploy capital. We raised a total of about 3 funds. We still deploy out of our Fund 3 vehicle into each new deal we do. So yes, we do have our own skin in the game. That said, about 2 years ago, the platform evolved into what it is today, which is just a pure play individual syndication direct co-investment model. So each deal is created as its own SPV. There is no cross collateralization across assets or whatsoever or debt. And it really just kind of allows our investor base and LPs to pick and choose which offerings they want to participate in for any number of reasons that make sense to them. I think that this fundless sponsor model that we've adopted is actually going to gain a lot of credence in the future. And I actually see more funds kind of moving towards what we've already done, which is this direct individual syndication platform that so far I think really works.
Got it. Yeah, and something we talked about, this movement of people. We have COVID. We still have these companies expanding, their office space in these times. We talked a lot about the demographic change from the person and then the individuals, but it feels like it's a bit of the companies as well. We have a much bigger Google office here in Austin. We have Tesla moving out of California to come here. It seems like just the job market was already spreading out a bit just from the company side as well. The job demand, they're looking to demand and supply mix as well from the company side.
Yeah, I think that's right. I mean, I think that the residents are leading the charge, but the companies are certainly to follow. I mean, if you're the CEO of a big company or a corporation, how are you not thinking through moving a percentage or a portion of your labor pool from a high rent, high tax, high pay city like Chicago, New York, any of the California towns, to a higher value location like Kansas City, Kansas, for example, where you're going to pay less in rent, you're going to pay less in tax, and quite frankly, you've got the optionality to pay your employees less wages than you would in Chicago. At the same time, you're going to have more control over your environment, which enables you to kind of put protocols in place to not only make your employees safe, but make them feel safe. And I think the reality there is that even though the future probably does call for some increase in full-time work from home, I think the statistic pre-COVID was about 4% of the US workforce was 100% remote. Maybe by the end of this, we land somewhere closer to 10%. I think a lot of the other numbers are being wildly overstated. That said, those bodies and those workers that remain in the office, they're going to demand more space. So, if there's fewer workers, but less density, we think that there is some equilibrium that's going to be achieved.
Yeah, and I mean, I've already seen it. We have a friend here who works at Snapchat who's staying with us in Texas. The San Francisco companies kind of offered their employees and said, "Hey, we'll give you a 10 or 20% pay cut. That's the offer if you want to move out of California permanently." And a lot of employees took that right away. They jumped on that. They were fine with the pay cut. They're moving to these secondary and third markets. They're leaving the high tax areas as well. And they're fine to take a huge haircut to do it. So that equilibrium is finally shaking out in a place like San Francisco, where that pressure had already been pushing on there.
Yeah, I saw a pretty kind of daunting statistic. Since COVID, about 22% of people have left both San Francisco and New York City, or know somebody that has. The mass exodus and arguably the flight to safety there is just incredible. I lived in New York for about 14 years. I don't believe this narrative that New York is dead, but I do think that in a couple of years there might be some buying opportunities in New York. Dare I say, some slight value that might not ever exist again for another generation.
Yeah,
lifetime at least.
My friend there in New York, about a third of the city is full. On his observation, most young people are in Long Island or in Maine or in Massachusetts, rural Massachusetts, with old family and friends, just staying out of there. A friend in San Francisco, she immediately demanded a 10% rent decrease and got it from her landlord immediately, which is
incredible. Yeah, that's remarkable. That would be
unheard of.
To even to be able to entertain that conversation, 2 years ago, I mean, you would just get laughed out of the room. That's fantastic. I like hearing those kind of stories.
Yeah. So, we're a few days away from the election here, and we'll keep things non-toxic. We know everyone's tired of that. But, there's Trump, who's obviously been a real estate developer, always been extremely business friendly. Biden coming up here, one of the more moderate Democratic candidates, definitely has some changes in policy, definitely more moderate than Bernie Sanders or Elizabeth Warren. Where do you see with real estate on the rocket dollar side? We've heard of the 1031 exchange being under threat. Where do you see some potential policy or economic things playing out in Washington across the country?
Yeah, that's the $1 million question right there. And I think you're right. I think on the real estate front, the two major factors there are the 1031 exchange, whether they allow for to qualify for a 1031, which is a complete tax-free exchange as long as you move the proceeds from one real estate investment sale into another. I think they might be limiting that to around 400K, which would be a humongous deal. I need to double check on that. And the other is going to be what Biden would want to do on the individual kind of capital gains rates. What Biden has what he's proposed taxing in terms of taxing long-term capital gains and qualified dividends is at an ordinary rate for taxpayers with taxable income above 1 million. So traditionally, dividend income that you've generated from stocks or kind of a dividend or passive investment like we do has been taxed at a lower tax rate than your ordinary income rate. He would basically level that out, and that could be huge in terms of how investors are looking at kind of both income-oriented dividend-paying stocks and companies, but also real estate investments, which in some cases like ours, where, our return on investment is primarily driven through cash on cash yield as opposed to back end IRR or capital appreciation, it can really have an effect. Our investors are really kind of looking for mailbox money, passive income. And we're trying to solve for that 8 to 10% cash on cash yield in which we distribute to our investors on a quarterly basis. If some of Biden's proposed policies were to go into play, it could turn, more traditional kind of conservative real estate investors into slightly more aggressive real estate investors, because the real opportunity would then, there would be the taxing would kind of make the opportunity and the risk reward a little bit more attractive in terms of back end IRR appreciation. And for somebody like us who's trying to invest in income oriented, cash flowing, highly occupied credit quality tenant properties across our portfolio, it could make our offering seem a bit more drab.
Yeah. This is where I just want to, pump up, obviously, the self-directed IRA or the solo 401k. The 1031 exchange, and, that losing that, or obviously the tax and the capital gains, those are drivers to saying, hey, try doing another deal, try doing a second deal in a retirement account. We have two usual types of investors at Rocket Dollar. Obviously, we have so many different assets that people come to, but they really break down into two categories. There are people taking, hot shots, really aggressive shots on an asset and hoping they can get, preferential tax treatment on that over a shorter long period of time. And then there's a second group that's really looking for income and yield. That income and yield investor, they really love their real estate. They really love that, the bond markets, when stuff's really getting hairy over there, they love that they can come to Rocket Dollar and work with a partner like Excelsior to get into a yield type of investment. So especially if capital gains tax increases, we're trying to get the word out there. I feel like some more investors might be driven to say, hey, maybe I should consider this through a retirement account.
Yeah, absolutely. I mean, that's a great point. And something that we've been really active on in our front is just trying to, admittedly, full disclosure, I've just recently been able to kind of realize and recognize the power of the self-directed IRA. I really always thought that kind of qualified traditional IRAs, the sub-accounts or investments that you were relegated to, was traditional kind of long stocks and bonds, mutual funds, ETFs. That's not the case. And the fact that it's really a world of open architecture. You can do anything, as I understand it, and correct me if I'm wrong here, Brendan, but anything from, you could invest in, at some level, art funds, fine art, to cryptocurrency, to commercial real estate, to hedge funds, and everything in between. And I think for the accredited or more sophisticated investor, just kind of having that more open universe can be humongous in terms of what you can do with your overall portfolio, especially when you're talking about an account that's growing tax deferred or tax free.
Yeah, and we have a lot of really varied investors. I would say the art is the only thing that we're a little hesitant on, because it could still realm in the collectible category. But that's the amazing thing of the IRS. It's a very small, people ask, we had a customer ask, hey, is it a blacklist or a whitelist with the IRS? And it says it's a very small blacklist. It's no collectibles, like a Ferrari. Art is kind of pushing it in some way. Some people have tried to do the securitization of art, like buying a share of a Picasso painting. We're a little hesitant on that. But, and some S Corp stock and insurance. That's it. Commercial office space, an investment down the street, lending to a real estate, builder or owner that you trust, going with a more established fund like Excelsior that knows their stuff. The options are really out there. And especially with the checkbook IRA, you just need to make sure that's in the name of the IRA LLC. All of a sudden, you're getting those nice gains on there. We have people, the best most productive investor at Rocket Dollar last year has cattle in his IRA, which is kind of funny for people to hear. But he has prized Longhorn cattle across Texas, and he beat everyone else. As far as pure performance. So it's really great to see. We have a lot of investors that are both creative or finding something, more comfortable for their investment thesis in these types of accounts.
I think that's so cool. Investing in cattle through your IRA. I mean, that is
Yeah.
a nerd, but I'm fascinated by that.
The other guy, the other craziest one is a guy in Portland, and he does timber. And he has a field of prize timber. He has insured hopefully with the fires and stuff there, but he's in around Washington and Portland. And he's going to cut that down in 30 or 40 years. And wood's pretty expensive now, as you can see, with building materials and all that.
Just to touch on the election and the market, because I know that's kind of more of a compelling conversation to have, especially as it's so timely. There's an old saying in the investment world: the market can handle good news, the market can handle bad news. What the market cannot handle is uncertainty. And as we've been living in this kind of period of economic and political uncertainty for most of this year, I think investors need to be bracing for the possibility that the worst is yet to come. And I think there's an increasingly real chance that we wake up November 4th with this election in to be determined mode, a scenario where both sides are claiming victory, and it takes several weeks, if not months, and court rulings before we're able to arrive at a winner. And I don't think the market really cares at this point if it's Biden or Trump. But the market is going to go a little schizophrenic if there isn't a clear-cut winner and it goes on for an extended period. That's where things can get really, really hairy. And I'm starting to feel, it's just obviously purely my opinion. I'm starting to think that we're likely not to wake up on November 4th and know who the president is.
Yeah, and just a little scouting report from Texas here. As we said earlier, the votes from Texas are probably some of the highest they've been in a long time. Saying with a local friend here, if Texas is determined on night one, it's very clear. Biden won the election if he somehow pulls that out. That's a very long shot, but it's still possible.
Sure.
If it's not, if there's several swing states, I went to college in the state of Wisconsin. That's very clear for Biden, but there's a lot of states that can be toss-up. Pennsylvania, Florida, these things are contested. And if it's like a Gore situation, we could probably see from now until, January before there's some settling in. And, business leaders around the country, they obviously like Trump's, pro-business, anti-regulation stance. But then when you look to Biden, a lot of business leaders say, hey, there might be a bit more regulation, but at least we know what's going on. It's very expected. Yeah. And the market likes that consistency, that they know what to expect. So
for international stability with Biden.
Yeah. So we've had a it's been a good year stock-wise, but, a lot of people are trying to see what's happening, what's going on. We've got a lot of tech stocks. Every tech stock is very high, but everything that has more of a physical or much more determinal value, some of those are hurting. And we have a stimulus package, which has not been passed because of the deadlock in Congress. And there's a lot of renters that are kind of relying on that to get that stimulus to make sure they can pay their rent checks, continue to pay their landlords. Which then feeds into the greater real estate market. So my kind of thought on the market itself is that, another stimulus package really has to get out before a vaccine comes. And if that comes, you'll see a lot of calm settle back over the market. But if that's not done until January, 30th, all right, I'm back here again, hopefully. If that stimulus package is, am I back on, Jonathan?
You're back on. I can hear you now.
All right, apologies, but the pandemic Wi-Fi is not great back here.
Right.
But basically, my final opinion is that if the stimulus package is not done until January 30th, I think and the election is unclear. I agree with Jonathan. You'll see a lot of possible chaos and uncertainty in the next couple months here in many different markets.
Yeah, and I think some of that chaos and uncertainty in the markets will coincide with chaos and uncertainty in communities, and I think that this could be a real time, this period of just not knowing who the rightful president and winner of the election is, could lead to a lot of unrest and potentially a lot of violence. And the market is not going to like that at a time when COVID is now rearing its head for the second, or depending on who you ask, third time in a new wave. It just feels like this entire year it's just been such a perfect storm of worst case scenarios coming together to force us as humans to show our moxie. And everybody's got their 2020 jokes, but we're going to get out of 2020 and be in 2021, and a lot of these issues aren't going to be resolved.
Yeah. And from my perspective, a lot of these middle and upper class families are doing just fine as far as, money. They're working from home or whatever. We've really seen, a lot of working class people have a lot of trouble. And that's what I think is affected by this lack of stimulus or that gridlock in Washington. So, in the suburban office market, in the higher level markets, I think real estate, they will be fine. But in some of these other working class markets, there's a lot of people trying to look for their next paycheck, potentially, maybe facing eviction somewhere in the next, 6 months if they don't get some help in some way or another.
Agreed. I think it's really shown a very bright light on who the real essential workers really are. I mean, in the absolute, what felt like the apex of COVID, and call it April, May, I was just so appreciative and have just developed such a deeper level of appreciation and fondness for, grocery store employees, what they're doing. That's the essential workforce. That's the things fall apart if they don't show up to work kind of demographic. And, the knowledge economy, which to your point, has been able to kind of seemingly skate a little bit easier and just continue on with their life, working from home, working from remote, and not really missing a beat. I wouldn't be surprised if some of those jobs start getting outsourced to Asia and Europe. I think that regardless of what happens with the market, that there's going to be a lot more layoffs across industries in the first half of 2021. And I'm concerned about that too.
Okay.
I think any type of stimulus bill, and I'm hoping that number is somewhere between 1.5 and